As you probably know, it is getting harder and harder to find a good deal in the stock market. That is why we are going to use this equation to find the best deal today. And welcome back, YouTube. It is your boy Cole, and if you are new here, absolutely think about subscribing. Grab your cup of coffee and let's dive into the stocks you need to own right now. The guideline I came up with for these stocks were they have to have a clean balance sheet, they had to have revenue growth, and they have to have a low PEG ratio. And if you're not familiar with the PEG ratio, let me break it down really quick. Basically, a PEG ratio is getting a little bit deeper than a PE ratio. And the reason why I want to use a PEG ratio is sometimes when you get an inflated PE ratio, you tend to not look at that stock. A lot of these big growth companies, you need to look at their PEG ratio and not necessarily the PE ratio, because the PE ratio is going to be so inflated that you're not going to understand the true value of the company. So what a PEG ratio is the PE ratio divided by the EPS growth. And you use a whole number, not percentages, when you divide it. So that means if you have a PE ratio of 10, a growth rate of EPS of 10%, then your PEG ratio is going to be 1. So what we're going to do is we're going to use that equation plus a clean balance sheet to decide where we're going to find our greatest value in a very expensive stock market. You probably know it is getting harder and harder to find a good deal in the stock market. That is why we are going to use this equation to find the best deal today. Some of my stock callouts have been Pfizer at $27 to $28 and is currently trading at $45. Not only were you getting a cheap stock, but you also got almost a 4.5% dividend yield with that price point. Another call out I had was Dropbox at $18, which is currently trading a little over $32 today. These three stocks I'm going to give you has just as much upside as those. Let's dive into the three stocks I'm giving you guys today. The first stock is going to be the boring stock of the bunch. That is going to be a safe stock that pays you a dividend, and it's not going to have huge upside, but definitely some serious upside into it. First is going to be none other than AFLAC! That annoying duck AFLAC. I know, sounds crazy, but during the pandemic, AFLAC actually grew revenue, and a lot of these companies I dove into had no PEG ratio because they had negative EPS during the shutdown. Believe it or not, AFLAC still grew EPS during the shutdown. And with 9 million people still laid off, there is a huge upside to AFLAC. And not only is there a huge upside to AFLAC, but their dividend aristocrat status is extremely impressive for safety. If you're unfamiliar with AFLAC, they are in the insurance business, in all aspects of insurance, which is not only necessary, but extremely profitable. So when you think about insurance, that is going to be long-term insurance, short-term insurance, dental, vision, health, life insurance, both term and whole life. So they're a global company. Let's dive into AFLAC's PEG ratio and their balance sheet right now. As we can see, their gross profit margin is pushing 40%, which is just unbelievable. The revenue is at $23 billion with revenue growth of 6%. Now, 6% doesn't sound great, but when you compare it to other blue chip stock companies that had negative growth due to the pandemic, this is phenomenal. As we see here, AFLAC's PEG ratio is below 1. Anything really 1 and below, you can absolutely find some value in. AFLAC is at 0.06. Technically, I believe it's 0.12. I did the math myself, and I came up with 0.12, so I think seeking alpha is possibly a little delayed, but still, tremendous value to be had with just the PEG ratio and looking at revenue growth of 6% with a consistent dividend yield of 2.35%. This company needs to be in more conversations today. Ridiculously strong cash on the balance sheet at $7.14 billion. Total debt is only $11.26 billion, so they literally could pay off all their debt with the cash on the balance sheet. They have net operating cash at $5.68 billion and free cash flow at $2.54 billion. The great thing about this is when you go to Yahoo Finance, it is extremely undervalued and underappreciated. It has a 45% upside, would give it about a $70 to $80 price target and a 2.35% yield. Now, personally, I don't know if it's going to hit those levels, but I would not be shocked if we see new highs in AFLAC this year with the hiring frenzy that needs to take place. in order to fill all these empty jobs out there. This is a huge opportunity for AFLAC to capitalize, and they've already proven they can do it in a slow economy. Not even a slow economy, but a shut down economy. Number 2 on my stocks to buy right now is going to be Etsy, ticker symbol ETSY. Etsy is a part of the exploding online shopping experience that everybody's looking for. Etsy's platform connects buyers and sellers. It's no surprise with the blowing up of online shopping that Etsy made this list. Founded in 2005, when I dug into their finances and the PEG ratio, I was extremely surprised at how strong financially this company is. Absolutely mind-blowing, and is a stock you must own going forward, especially after the dip that it recently had. You can see here by Yahoo Finance, they think it's at near fair value with only 7% upside, but the 1-year target on it is 226, and I think that's probably more accurate, especially when we dig into the PEG ratio. With a bloated PE ratio of 51, it's really easy to look away from this stock. And when you dig deeper and look at the PEG ratio, you're going to be pleasantly surprised with this company and the growth of their revenue. Here, the PE ratio is 51.4, and normally I would turn away from something that high. But then we see the PEG ratio at 0.3 and realize that if it's under 1, there's probably some value to be had. So let's dig a little bit deeper. Gross profit margins are sick at 73, almost 74%. With revenue at 2.15 billion and revenue growth at 91%, you have to dig deeper into this company. These numbers are just unreal. That the total cash on this balance sheet is at 2.48 billion and they only have 2.3 billion in debt. It's just unbelievable at how sweet this balance sheet really is. With net operating cash flow at 699 million and free cash flow at almost $500 million, this is extremely impressive for such a strong growth company. This is extremely impressive for a growth company, and I don't think online shopping is going anywhere anytime soon. And even if we had another shutdown, Etsy is going to score even more. Well, if you made it this far in the video, don't be a cheapskate. It costs you nothing to like and subscribe. And let's get into the third stock that you need to own right now. The third stock you need to own right now is going to be CORSAIR Gaming, ticker symbol CRSR. So, when we dig into CORSAIR Gaming, you're going to be extremely surprised by this growth company's balance sheet and PEG ratio. Not only that, but the tremendous amount of upside and market opportunity that this company has. It is unbelievable. Yahoo Finance, CORSAIR Gaming, ticker symbol CRSR, is undervalued by Yahoo Finance. It has a 78% estimated return with a 1-year price target of 46.67. It is currently trading at 28.08. After they had a disappointing earnings, I dove into their finances and I said that this is a steal buy at $26. If you were unable to scoop up those shares, don't worry, I do think we'll see it come back down about $27 to $27.50, so you might have an opportunity to still scoop up those cheap shares. 52-week range at $14 to $51. We have a price per share smack dab in the middle. If you're unfamiliar with CORSAIR Gaming, they pretty much design, market, and distribute gaming and streaming products. And if you saw my last video, the reason why I'm so excited about CORSAIR Gaming is they're actually growing in their most profitable division. So if you haven't seen that video, I'm gonna put it right here. So as we see here, it has a PEG ratio of 0.15, just unbelievably cheap when you look at the growth of this company. Gross profit of pushing 28.5%. Revenue is at $2 billion with revenue growth at 55%. Total cash on the balance sheet is $134 million. They only have $330 million in debt, and their free cash flow is $104 million, and net operating cash flow is $152. As you can see by this, CORSAIR Gaming has a clean balance sheet, extremely low PEG ratio, and has huge opportunity with the fact that it's in the gaming and streaming business. Not only that, they did come out with a new camera that looks phenomenal. The thing that is exciting about this company is not just on paper, but the innovation that's taking place within their business. If you haven't been following CORSAIR, you better start, because they're becoming seriously one of the most innovative companies out there, in my opinion, as far as entering a market that I think is just exploding. So with that being said, CORSAIR Gaming, I believe, has so much upside that I wouldn't be surprised if this was a $60 to $75 stock by the end of next year. Well, I hope you enjoyed my dive into the 3 stocks you must own right now. As always, guys, thank you for spending your time with me, and we will see you next time, investors. Peace.